All right. So I do want to start right on time, and we are at 101. So because I'm diligent about starting on time and finishing on time. And so thank you everybody for joining us today. And I'm gonna let Jordan tell you his background instead of me going through this. But we have with us today Jordan Levine from C.A.R, and he is going to do a update for us today on what is happening in with the economy and where we see us going for the future and everything. Real quick, a shout out to our 2020 president, Eric Wong, who little did he know what he was getting into when he accepted this role, but he has been phenomenal.
Oh my God.
So let's all give him a big old hand, Eric Wong, our president. Yeah, he's just been phenomenal. So I am going to turn it over right away to Jordan Levine from C.A.R. Thank you very much, Jordan.
Hey, thank you, Davina, for having me. Let me share my screen so that we don't have to all stare at my face and get this into slideshow mode. There we go. So yeah, my name is Jordan Levine. I'm the Deputy Chief Economist at C.A.R. Most of you know my boss, Leslie Appleton Young, and I'm kind of the resident data nerd of the bunch, if you will. And this is kind of our COVID-19 economic and market update. This is fresh off the press, so a lot of the data just got updated yesterday or today. So the way that I'm going to go through it is to walk you through the data that we've gotten up till this point, which, the thing to keep in mind is that economic and market data is always inherently backward looking. And so it's taken a while for data to even start to come in. It has started now, and the data that we're seeing is pretty ugly, right? We're seeing pretty unprecedented shocks to really the three indicators that matter most for the housing market: unemployment, consumer spending, and of course GDP itself, which is just that econ nerd's way of saying the amount of income that's being earned by businesses and individuals out there in the economy. And so as these kind of key indicators are showing the effects, so too do we see this kind of filtering through to California's housing market in particular, where again the data is also pretty ugly as of the April release that we just put out yesterday. And so we'll walk through that. Unfortunately, I'm not coming to you today as the kind of one-handed economist, right? I think it was President Truman who said he wanted a one-handed economist because they were always saying, on the one hand, but on the other hand, and I have to kind of use both hands this time as well, because in some ways we're finding signs that the economy and the housing market are starting to reach bottom. So we've seen these declines that we've been going through for the past 2.5 months starting to decelerate. But on the other hand, that bottom that we're starting to get a sense of is pretty deep, right? And so closed sales are still lagging way behind, and it's likely that we'll see some price impacts in the market eventually. But again, as we kind of get to bottom and kind of have more sense of certainty, or at least less uncertainty about how deep this is going to be and how severe, that's a sign of hope, right? Because we couldn't say that even as recently as a couple of weeks ago. And yet, even as we do get our arms wrapped around the size and scope, we're recognizing just how painful it's actually going to be. So we'll go through the short run outlook, right? And most forecasts are calling for the economy to be down pretty significantly during the second quarter, something on the order of 30 to 40%. And C.A.R. itself is in that camp as well. But more importantly, I think that we're in for a relatively slow recovery, right? And so we always think about like the ABCs of recessions, right? Is it going to be V-shaped, W-shaped, L-shaped, U-shaped, what have you? I would offer up that we're looking at something like a J-shape, and I'll go through and define what that means and tell you what I think it means in kind of plain English for the next couple of months and years. But then I want to end on the long-term view of housing, because I still remain relatively optimistic about housing over the long run. In fact, I think that once the dust settles on this thing that housing could potentially be one of the bright spots. And so we still have all of the kind of long-term benefits that have always made home ownership attractive, the wealth creation, the health and educational benefits for your kids, the social mobility, the engagement, right, the civic engagement, all that good stuff it remains an important aspect of home ownership. But I also think that we're going to see this crisis kind of accelerate or kind of accelerate the pace with which we move to some of these things that had already been bubbling under the surface, including remote working and telecommuting and all of that stuff. That's going to open the door for many more people to be homeowners without having to grapple with maybe the home prices that they can't afford in the areas that are closest to where their company's physical location is. And so all of that being said, let's start with the ugly stuff first, right? Because we are seeing pretty unprecedented impacts to the economy and the housing market because of COVID-19 in general, but really because of the shelter in place clamping down on our ability to generate economic activity. And where the rubber really meets the road on this is in the labor markets. We always talk about the labor markets being the single largest driver of the housing market in the good times. But unfortunately, the reverse is true in the bad times as well. And what we can see is that, at least in terms of unemployment insurance claims, which we'll get new data on Thursday, but even just over the course of the last 8 weeks, we've seen almost 37 million people file for unemployment insurance. And you can see that just visually, this meets the definition of what it means to, literally be off the charts. We had to redo the charts to be able to fit on the last 8 weeks worth of unemployment, right? But also, just to put a finer point on this is think about 2008, right? The Great Recession was the worst recession since the Great Depression. And from January of 2008 into the midpoint of 2009, when unemployment insurance claims peaked, over that whole 18 to 20 month period, we had about 37 million people file for unemployment. So you can see visually that doesn't even really register as a blip anymore on this chart. But also we've accumulated basically the sum total of the worst part of the Great Recession's unemployment in just a little under 2 months, right? And so this is the real deal, because when people aren't working, this is what the econ nerds like me like to call the multiplier effects. But really, if people aren't working, then the businesses downstream of individual income, which is basically every business out there, right? We take our paychecks, we buy cars, we make car payments, we take our families out to eat, we buy stuff, etc. Those multiplier effects, all of that downstream stuff can't happen. And low, that is where we're at. When you look at the actual non-farm job numbers, we shed about 20.5 million jobs during the month of April alone. What I've done is I've annualized up that growth rate for you. And what I'm showing you is that you have to really go back to the end of World War II, when we were shuttering bomber plants and not manufacturing tanks and munitions and fighter jets and all of that stuff, to even find a month of employment that was even half as bad as the job losses that we experienced in April. And so again, very significant things that we've never seen. They always say that the economist is like the guy who's driving by only using the rear view mirror, right? We know where we've been, we think we know where we're going, but this is what makes the job of driving with only the rear view mirror so difficult, is where in the rear view mirror do you see anything that looks even remotely like this, right? And so that's where all of the uncertainty comes from at this time. But we do know that it's severe. Now, we won't get data on California's unemployment rate until Friday. But what I've done is I've taken the roughly 4 million or so unemployment insurance claims for California, which we get on a weekly basis, and just tried to do some back of the napkin type of estimates about what California's unemployment rate is going to look like when we eventually get this April number on Friday. And, it's somewhere between 18 and 22%, right? And so, you can see just how quickly this thing ramped up, but also, again, going back to the Great Recession, right, we topped out at just a little over 12%. So we've already blown way past, almost by 50%, past the peak unemployment that we had during the worst recession since the Great Depression. So again, you know, labor markets have really taken it on the chin, and that's true here in California as well. And the reason why that matters is because, again, this is those kind of multiplier effects. And I don't know why these turned white on me. Hopefully you can still see those on the right hand side, but you know, it's led to, these are the multiplier effects, right? When people aren't earning income, we've seen record declines back to back for consumer spending as measured by retail sales, which on an annualized basis were down 65% in March, when we only had really sheltered in place the second half of the month, and continued to decline at an accelerated pace of 88, almost 90% in April, right? And so again, when you think about retail sales, that's like basically our local economies, right? That's the car washes, the movie theaters, the grocery stores, I think, are still doing okay, but the bars, the restaurants, the shopping malls, et cetera, very broad-based and very significant. I only brought you a couple of years, but take my word for it, if we zoom this all the way back for 50 years, you wouldn't see declines like this, at any point in time. And of course, the reason why this matters is because, our economy is more than 2/3 consumer driven, right? So as go consumers, so goes the economy. We already got a 4.8% decline for the first quarter, when again, only about the last 2 weeks of the quarter were actually impacted by the shelter in place. But if you look at the Atlanta Fed's model, and this is just a very objective model, they're not putting any interpretation. All they do is just feed in data on a weekly basis and spit out what the machine tells them it's going to be. They do a decent job. It's not perfect, but they're projecting a 42, almost 43% decline for the economy during the second quarter. And again, when we think about it in the kind of non-econ nerd terms of just being the income and revenue that's being generated out there, essentially in the economy, that is real, honest to goodness impacts, right? And so we need to be prepared for the bottom to be pretty painful. I don't want to be the grim reaper of economic data, so I'm not going to beat all of these issues to death here, but just to show you kind of a smattering of the different records that we're breaking across all these various aspects of our local economies and national economy. Very broad-based, and we expect that something on the order of at least 5 million people, probably more, have asked for permission to skip mortgage payments, right? And so, again, this is hitting households right in the pocketbook through the labor markets and through their income, right? And so as the macro economy goes, we've seen that realtors are experiencing this in their business as well, primarily because all of this economic data is backward looking. One of the things we started doing that very first week of March was reaching out to between 500 and 1,000 realtors over every weekend to get a sense of how this was playing out on the ground for us as practitioners. And we could see that realtors are seeing this show up in their business as well. So we're still basically at a point where, almost 2 out of 5 realtors have had buyers who have not just gotten generalized cold feet, but actually withdrawn an offer because of coronavirus, right? And that's down from 4 weeks ago or 5 weeks ago, when it was almost half of realtors that had a buyer withdraw an offer. But that's significant, right? Because it's not just generalized cold feet. They're actually deciding to press pause when they had otherwise been ready to pull the trigger and had that RPA already in there. Similarly, on the sell side, right, that we see, again, almost half of all realtors that we talked to over this most recent weekend. I don't know why my dates got cut off, but this one also goes through May 15th to the 18th. So it just closed yesterday. 47% of realtors have had a seller not just get cold feet, but actually pull their home down off of the MLS, right? And again, that's down from almost 60% where it was about 5 or 4 weeks ago, but we're still talking about almost half of all realtors have had sellers take that step back. What's interesting and in some ways, potentially paradoxical when you think about all the economic data that I just showed you, it's sometimes counterintuitive, but if you put both of these charts together, what we see is that actually sellers have taken a bigger step back than buyers, right? The percentage of sellers that have taken that step back is higher than the percentage of buyers. And so when you think about it from an inventory standpoint, the market is still relatively tight, right? And we see kind of that same sentiment playing out on the consumer survey. So every month we also do a housing sentiment survey. These are just California consumers. And we ask a couple of very basic questions, two of which is it a good time to buy a home? And is it a good time to sell a home? And you can see that same phenomenon playing itself out in these numbers as well. In fact, good time to buy a home's actually gone up in May to about 31%. It's never been a particularly good time to buy a home in California, according to these consumers that we've been talking to, right? It's always about 28 to 30%. There's not enough inventory, prices are unaffordable, et cetera, et cetera, but actually no significant deterioration from where they were in, January, February, March. In fact, with rates at historic lows and at least the perception that there might be some deals out there, buyers are feeling pretty good. Look at sellers though, right? What a contrast with the percentage of sellers dropping by more than half and actually 2020 was shaping up to be a pretty good year, right? You can see that the numbers for 2020 pre-coronavirus had been ramping up, that over 60% of people that we talked to thought it was a good time to sell a home. And you can see how much that has been impacted in the April and May numbers. And so a much bigger impact on the sell side of the equation, which again is why I think that, inventory is still relatively tight and we're not really seeing much on the price impact side, which again seems counterintuitive from the standpoint of being in the worst economic crisis since the Great Recession, or from the Great Depression, excuse me. But when you think about it just from the Econ 101 fundamentals of supply and demand, supply's taken the bigger hit so far than demand. And in fact, when you look at the price numbers that we released for April, on a year-to-year basis, prices were still up 0.6%. Now, that's nothing obviously to write home about, but a far cry from what many people expect home prices to be doing. Even relative to where they were in March, we only saw the median price come down by 1%. So very, very modest price impacts yet. And even when you kind of zoom it into the weekly data, what you can see is that like in that kind of, these are in weeks. So the yellow weeks, like 14 and 15, it's like the mid-April timeframe. You can see that there was some initial impacts to home prices in the Bay Area, but actually they've been remarkably stable over the course of the last 5 weeks. But we see that across the state as well. It's not just a Bay Area phenomenon, right? We see that prices actually in Southern California last Friday, week 20, were exactly where they were in week 10 before the shelter in place. So they're not really growing the way that you normally expect to see, halfway through May, spring home buying season, essentially. But we're also not seeing those precipitous declines circa 2008 either. And you can see that same phenomenon in the Central Valley, Central Coast that we're seeing right there in the Bay Area as well. All of that being said, even though we're not seeing the impacts to prices, buyers think there have been impacts, right? And so when we talk to realtors, again, I don't know why my dates are getting cut off here, but that green one represents the survey that we just did over the weekend that closed yesterday. We're still seeing between 80 and 90% of realtors that have buyers who expect prices to be impacted, right? So we're not seeing that in the actual data, but there's a lot of that psychological scar tissue left over from 2008, where we think that, for folks who are under 45 years of age, there may be one formative experience with recessions is the 2008 flavor of recession where prices dropped 50%, right? And so I think that there's a lot of that psychological scar tissue left over, that is causing buyers to think home prices are going to drop significantly by several $100,000, and sellers are just not on the same page. So if you look at the right-hand side, we're looking at less than 30% of realtors actually have sellers reducing price to attract buyers. And so, from the standpoint of sellers, the coronavirus impacts and the shelter in place are temporary in nature, not structural, the way that they were in 2008, where we had households and banks that were over leveraged. We had people with, zero savings rates nationally, essentially no cushion to make it through. We had tons of 5/1 option arm adjustable rate mortgages, right? And all those ninja loans, the no income, no job or asset type of mortgages that really precipitated that financial crisis of 2008. Even though a lot of those things aren't present this time around, buyers think they are. And so there's this huge gap in expectations between, what buyers think is happening or should happen with prices and where sellers are, because I showed you that most sellers are just opting to take their home off the market for a little bit, right? Maybe they put it back up in July or August. Maybe they wait till next spring when the dust is really settled and this thing is in the rear view mirror. But what we don't see is them rushing to get ahead of a deeper financial crisis and start really dramatically cutting prices. And so really it comes down to the question of who's really going to win the battle of expectations, right? Because if you look at active listings and just ask a simple question, what percentage of our active listings are discounted, you can see that it's basically that same 28, 29% of active listings that were discounted before the shelter in place order was even issued. Now, there is some nascent signs if you look at closed sales that there is a little bit of an increase from in terms of the number of closed sales that closed below whatever that original list price is. But they're actually, even there, the numbers are, although up from where they were a couple of weeks ago, below where they were even before the shelter in place went into effect. And so I think this might be a case where you're seeing that sales prices could lead listing prices, with softness, right? That sellers think it's temporary, but eventually home buyers might start to negotiate that down. But we're not seeing a huge uptick in the percentage of units either on the closed side or the active side that have had big jumps in price reductions, essentially. And so we're seeing that in terms of the opinions of realtors out there, right? That buyers and sellers are holding back, that there's this gap in expectations, and that obviously the macroeconomic impacts that I laid out are having an impact in the way that they're doing business. But we also see this showing up in the MLS data. And so the other thing that we've been doing, in addition to surveying realtors every week, is to actually jump into every MLS in the state every single day to try and get a sense of just how this was playing out for closed, active, and pending. And we can see that in our monthly press release that we put out yesterday. We had our biggest month-to-month decline in the period that we've been capturing this data, basically back to the late 1970s. So you can see we dropped 30% on a year-to-year basis after dropping already 6% in March. And we're down at basically a pace of 277,000 units on an annualized basis, compared to about a little under 400,000 where we were pre-coronavirus. And so that is a big impact. And when we look at the actual weekly data, and again, week 20 represents the week that ended Friday, this most recent Friday, the 15th. And we should be prepared for the belt tightening to continue, right? Because we do not see this really flattening out for the May data to show a significant rebound or anything like that. In fact, the first couple weeks of May are already in the book. So we can expect that at least for the next 6 to 12 weeks that things are going to remain pretty tight from a closed sales standpoint. When you think about it from a regional basis, right? I brought the regional data to show you what it looks like in the Bay Area, but in some ways, I didn't even have to, right? If I converted all of these into percentages, we're looking at very similar percentage reduction across the board from where we were pre-COVID-19. Those first blue bars represent the first 2 weeks of March, and the brown bar represents last week. The percentages are very similar in California, Southern California, the Central Valley, as they are in the Bay Area, which in some ways isn't surprising, right? We're all suffering from the same macro-driven issue where we're all stuck at home and not out there working and spending money and doing all of that good stuff. And so when you think about it on a price point or a price segment basis, right, you see very similar things as well. These are all different slices of the pie, obviously, but no price segment is really escaping this unscathed. And you can see that very similar percentage-based declines across the board. In fact, the top was actually impacted a little bit more. So what I'm showing you here is the cumulative reduction between last week, closed sales last week across price segments relative to where they were pre-shelter in place at the beginning of March. And you can see that the stock market, which tanked much earlier and much more significantly than the jobs numbers, obviously, impacted the top end of the market more, right? So we saw faster impacts happening more significantly, right? Bigger percentage declines at the top end of the market of, between 60 to 80% compared to just quote unquote, 40 to 50% down in the lower price segments. But if you actually look at the 3-week moving average, so this is just the last 3 weeks of data, what you can see is that as the financial market has stabilized much more quickly than the labor markets, just as the labor market effects were slow to impact the bottom end of the market, and the financial market impacts were quick. Now that the financial markets have stabilized, we see that the growth at the top end of the market is stabilizing much more quickly, whereas we're starting to see those kind of labor market driven delayed impacts, right, of people losing their jobs and not earning that income starting to affect the kind of under $1 million price segment more significantly than they had been during those first couple of weeks, which makes intuitive sense, right? If you're buying a $400,000 home, you're usually not relying on a giant stock portfolio to do that in the same way that you are if you're buying a 5 million plus home, obviously. And so that's the bad news, right? That we're seeing these kind of unprecedented impacts across the macro economy in terms of people not having jobs and therefore not being able to spend money, and therefore the economy as a whole shrinks in terms of GDP. We saw that was impacting realtors in the way that they were responding to our survey and on the impacts of their business. And I showed you how that's playing out across closed sales, both in every region and every price point, that this really is kind of hitting real estate professionals right in the pocketbooks, right, that we're impacted by this unprecedented shock. But the good news is that we're starting to see signs that the market is bottoming out, right? So if you look at pending sales, you can see that pending sales started to decline much more quickly than closed sales. We didn't have this kind of pipeline of like that we had on closed side to work our way through the first half of March. As soon as that shelter in place went into effect, week 12 pending sales started to drop off. And in the Bay Area, we saw those numbers basically be cut pretty much in half, right? From about almost 1,400 pending sales that week before the shelter in place. And then we went all the way down to basically about 700 pending sales a week during the mid-April timeframe. Now that has rebounded over the last 4 or 5 weeks to about 900 pending sales last week, right? And so we've clawed back some of that decline, but we still remain relatively depressed relative to where we were pre-coronavirus, and also relative to where we should be in a mid-May kind of spring home buying season. It's not just that we're below where we were at the end of February. This was supposed to be prime time for seeing pending sales actually ramping up. And so, yes, we're finding a bottom, but we're still, below where we were and, below where we should be. And so we don't want to over celebrate even as we get these signs of hope and optimism, right? So I'm kind of, again, the two-handed economist. On the one hand, we're getting a sense of where this is and seeing things move in the right direction. But on the other hand, still a long way to go, and that's going to take some time. But we're also seeing those same green shoots on the active listing side, right? And again, you see those precipitous drop-offs going from about 1,700 new listings. These aren't total actives. This is new being added to the MLS. In that first week of March, we were adding 1,700 homes to the MLS every week in the Bay Area. And that dropped down to basically about, I think, a little under 900, actually. It was a little bit more than 50% decline, which has since crept back up to about 1,200 last week. but again, still below where we are, or where we were, and where we should be. So things are moving in the right direction. No, we don't want to over celebrate when we think about it for the bridge association. That's I'm pulling in the Oakland Berkeley transactions for you guys right here, just to show you how this looks in our own backyard. But in some ways, I didn't even have to do that, because we see very similar trends on the closed sale side, right? And these are daily closed sales. We went from closing between 15 and 20 sales a day down to basically a little under 10 in the week that ended on Friday. So again, when you convert this over into a percentage, we're looking very much like we saw for the Bay Area as a whole, and also just for the state as a whole, again, because these are really macro driven issues that we're suffering from. We're also seeing those same green shoots, right? If you look at the pending and the new listings in our area, same exact thing, right? Where we went from basically 20 to 30 new pendings or listings coming on every single day, dropped by between 50 and 60% in the mid-April timeframe, but have since started to kind of claw back some of those initial declines, right? When we think about it from a price standpoint, again, if you look at the listing prices in our area, very similar trend to what I showed you for the Bay Area overall, right? Where there was some initial softness on a per square foot basis, but actually over the last 4 to 5 weeks, prices have been remarkably stable. We see some volatility on closed sale prices, but if you go back and look at the closed sale chart there, top left, we're running on a fairly thin number of observations to be able to calculate median price. If we're only closing 5 to 7 transactions a day now, then that's why you see kind of all of this volatility on the price side. But when you look at discounting, even in our own market, again, you don't see this big increase in the percentage of either actives or closed that are significantly discounting. So even though I'm showing you the localized data for just Bridge Association of Realtors here, it really looks very similar to what I was showing you for the macro trends. There's other sources of light at the end of the tunnel, right? Showings are at kind of pre-crisis levels. In fact, we just got new data, and I wasn't able to incorporate it before this because it came out like 15 minutes before I jumped on this Zoom. But showings are actually up on a year-to-year basis as of last week. Mortgage applications had 4 weeks in a row of growth, and actually 5 weeks here in California. We're still 22% below where we were at this time in 2019, but we've had 5 weeks of starting to claw back some of the damage, and we were as much as 50 or 60% behind last year's pace, even just in that kind of mid-April kind of time frame. And so I showed you that we're already seeing the numbers come down for buyers and sellers backing out. The unemployment claims are slowing, and even though we're still adding millions of people to the unemployment roll every week, it's been by a smaller number for the last 7 weeks in a row. And actually, if you look at the virus itself, we've done a good job of actually flattening the curve, which is why the governor has slowly started to open the economy back up. So we're starting to see that light at the end of the tunnel. I don't want you to go out and get your best bottle of champagne and pop it yet by any stretch, right? It's way too early to be celebrating, but we are seeing not just in 1 or 2 indicators, but a pretty good handful of housing specific indicators that have, not bounced back to where they should be, but at least have started to move back in the right direction again and get our arms wrapped around just how severe this thing is. So the short run message is yes, we're seeing that bottom and getting our arm wrapped around just how deep and severe this thing's going to be. No, do not go out and spike the football yet, because it's going to take a while for us to rebound, right? And when you think about the ABCs of the recovery, is it going to be a V, a W, an L, or whatever? I would offer up the J-shaped recovery, because I think that we're going to see this kind of, and what we've seen actually in the data that I already showed you, is this kind of initial bounce back after an overcorrection, right? We initially dropped too much because we didn't know what to expect and a lot of uncertainty. And so we kind of had this initial catch-up effect, but now we're in for a period of slow growth, because a lot of these industries, even as the economy starts to open up, are going to face ongoing restrictions, and we're just going to have to figure out how to operate in a pandemic, a post-COVID-19 world. And that's going to take some adjustment before we can get to a period of accelerated growth to get back to where we're looking at. So when people ask you about the V or the W or the L, tell them Jordan said it's going to be a J-shaped recovery. And I think that's what we're seeing. So again, here's the pendings or the weekly listings numbers. They cratered almost overnight during that first week of the shelter in place, week 12. We've since seen it bounce back pretty solidly over the last 3 to 4 weeks, but really the last 2 weeks showed that rebound has really started to decelerate. So again, I think we had this kind of overreaction, right, that we've come back from a little bit, but now we're entering the slow growth phase of the J-shaped recovery. And so that's how I interpret the data. The other thing is, even as we kind of get our arms wrapped around how deep this downturn is, we need to keep in mind that 30% declines in the economy are going to hurt. It's great that we don't have the uncertainty about how deep it is. The bad news is that how deep it is painful, right? And so most of these forecasts are converging around minus 30%. That's true for us at C.A.R. with myriad asterisks, caveats, et cetera, et cetera. We don't just have one specific forecast now, but this is one scenario that assumes there's no second wave, that we continue to just basically open up from here on out at a gradual pace, that there's no double dip in the financial markets. And if that is the case, we're also in the kind of minus 30% for the economy in the second quarter, which means that from a closed transaction standpoint, we're looking at about a 35% decline for closed sales during the second quarter. Now, you'll see that we're forecasting things to gradually start to improve in the third and fourth quarter, right? Clawing back first 24% and then almost 9% again in the fourth quarter, but we're still talking about ending the year 13% below where we were at the end of 2019 for an annualized, change in closed transactions of more than 16% declines, right? And so again, that's painful, and so we need to be prepared that even as we start to recover, we still have us ending the year again 13% below 2019. It's going to take a while to get back to where we should be. What we think that means in terms of prices is, yes, there will be some price softness, and we do think that that kind of battle of expectations that I laid out for you will result in some price softness, but just not the snowball effects that would precipitate those bigger declines that buyers are looking for. This is a unprecedented shock, no doubt, but it's one that's happening to what was otherwise a relatively healthy economy. And that's a big difference from 2008, which is why we have kind of mid to high single digits in terms of price effects later in the year, as these labor market impacts really cause buyers to turn the screws to a certain extent on sellers a little bit, but really only talking about an annualized decline of those kind of mid single digits for prices. So I think that when we think about timing, right, China did it in about 4 months between February and May. We basically hit bottom in mid-April. So if you add 4 months onto that, it means July or August or something like that. I would actually offer up that it's going to take even longer than that. When you just divide up the 20.5 million jobs that we lost in April, more than half have been in these 5 industries that I think are going to face ongoing restrictions. And that means even if these 9.5 million jobs that we lost are just purely driven by what happens in the economy, and the economy starts to open back up, maybe those 9.5 million jobs come right back. It still leaves us with 11 million jobs that are going to be much slower to rebound, which is why I think that we're looking at a longer time frame. If you look at other people's forecasts for closed sales, you can see that we're all kind of in that same range. We said 35%. You've got NAR saying 41% down during the second quarter, all the way up to the mortgage bankers who think it's only going to be a 15% hit to close transactions, with varying levels of rebounds in the third and fourth quarters of 2020. But if you look at the chart on the left-hand side, it's pretty, the consensus there is that we're looking at basically mid-2021 before we finally get back to those long-run trend lines for closed transactions. Prices, everybody is largely in agreement for, single-digit price impacts, not 40 to 50%. but the trajectory of the recoveries are slightly different, but still, if you kind of take a step back, we're looking at like mid 2021 before we get back to those, again, longer term trend lines. And so we're going to have to navigate that difficult time, even as the economy starts to open back up. And so I think that we're going to have to navigate that macro environment, but we're also going to have to navigate the expectations gap, right? And so I think that it's critical, especially for the buyers out there, to know that this isn't 2008 all over again. The economy was on a strong footing in 2020, early 2020, and that wasn't the case back in 2008. Household balance sheets are in, much better shape. One of the upsides of that, 2008 financial crisis is that people got rid of a lot of bad debt. Sometimes they went bankrupt or foreclosed on a house, but just otherwise got their financial house in order. Savings rates weren't zero in 2020 the way that they were in 2008. We didn't have all those adjustable rate mortgages. In fact, too few people, in my opinion, were able to get into the housing market, over the last decade. And so, this is an unprecedented shock, and nobody's trying to suggest otherwise, but it's again a shock that was happening to what was otherwise a relatively healthy economy. The other thing is, on both sides of the transaction, we've got to keep it real with clients, right? Yes, the market is tough for sellers. Buyers are facing all kinds of financing obstacles and job loss, et cetera, and prices might even go down a bit, as I forecasted for you here today. But again, when you think about it from just a pure fundamental standpoint, the market is still tight from an inventory standpoint. Rates are as low as they've ever been. I'm sitting here today speaking to you as the son of a guy who used to brag about his 12.5% mortgage interest rate, like back in the early 80s, to all of his buddies. And I think that that's going to keep housing pretty attractive. And I think the other thing we've got to do as real estate professionals is not just sell the home, but sell the home ownership, right? And that's why, again, a guy like me, who's the son of somebody who didn't even graduate high school and worked at the parts department of our local Chevy dealership, can be here like doing an economic outreach. It's not because my dad had all these great connections and all this other stuff. No, it was the benefits of home ownership that let me just kind of focus on going to school and getting good grades and not worrying about, what I was going to wear, what I was going to eat, or any of that stuff, right? And just that's the long-term value of home ownership, the wealth creation, the intergenerational mobility, and all of that stuff. And from that standpoint, it almost doesn't matter what happens to home prices over the next 2 years. If you can get into a house that you can afford and make those payments, we know that it's the one and only way that you actually make money in this country, that guys like my dad end up doing all right for themselves and for their kids and everything else. And so I think that, stop looking at housing like we look at our Charles Schwab or our E-Trade account, and start looking at the long-term value. And I think if we do that, that's how we, help to successfully navigate this expectations gap that we're going to run into, frankly, in the marketplace over the next weeks and months. So the good news is that I'm still bullish on housing over the long term, right? And I think that as low as rates are today, they could go even lower, right? And it's not unthinkable to see 2.9% 30-year fixed rate mortgages. Again, all those long-term benefits, the health, the wealth, the educational benefits, what it does for future generations, all that stuff is still there. And I think that with the structural shift being accelerated by this crisis, that we're going to see more companies letting their employees work remote. And I think that remote work equals an opportunity to buy, right? The reason why we haven't seen home ownership bounce back is because we're creating tons of new jobs in the Bay Area and in LA and Orange County, and those are where nobody can afford to buy a home. If they can work remote, then they can start looking deeper in the Bay or up in Sonoma, or even in Contra Costa for people who live on the peninsula. Alameda and Contra Costa has a much more affordable housing stock, and so it just opens up this whole new dynamic where home ownership actually has an opportunity to grow, and we can really have the population be where the housing supply is, and not be trying to force population to be where the housing supply isn't. And so if you take that together with the fact that we've spent about 3 months all cooped up in our homes with our kids, and Zoom meetings, and dogs barking, and gardeners mowing when you're trying to do an economic forecast and what have you, that our homes are going to be even more important to us now than ever before. And so I think that when you put those four things together, it's hard to be anything but optimistic on housing over the long term. So if I had to just put a bow on it for you, I would say that the bad news is the data is rolling in, and the data is super ugly, and we're seeing the implications of that play out across the macro environment and across the housing market in particular, and that's creating not just kind of headwinds, but also this gap in expectations that we're going to have to largely be the ones to mediate out in the marketplace. The good news is that we've got our arms wrapped around how deep this thing is, and in fact, across several key indicators, we're seeing signs that we have actually reached or are nearing the bottom on this. I'd be remiss if I didn't take this one last opportunity just to keep it really real with you and say that we don't over celebrate this initial bounce back that I showed you in the data that we've seen over the last 4 weeks, because I think that this is all part of this kind of catch-up effect from an overreaction to the crisis, and that now we're entering this kind of slower phase of the J-shaped recovery. And it's not just C.A.R, right? I showed you those other forecasts from other housing shops, and they're all looking at 2021 or so before we really get back to where we should be, quote unquote. Of course, I'll have to come back and revise all this if there is a second wave of the coronavirus, right? So that was assuming that we just continue to improve from here on out. But I think to really wrap up, I would just say that it's way too early to celebrate, but we are seeing that this too shall pass, and that there is some light shining down there at the end of the tunnel. If you need any more information as time goes on, we're at CAR.org. Industry 360 is where all the nerds like me like to hang out. So you can get in there. We have like spreadsheet stuff if you really want to get down and dirty yourself. If you just miss hearing my voice, you can tune into the Housing Matters podcast, which we try and do every 2 weeks. We do like a weekly written breakdown. So if you're a reader, you can get that right there and read it for yourself. And we have lots of stuff that makes you the market expert that you can get out there and share, and it's free and downloadable, and in many cases at the city and county levels that you can take out and share on Facebook or in your email campaign or whatever. I do speeches like this all the time, so if you just want to update your charts, you can check those out, and always have like the latest and greatest on all of these stats that I showed here. So yeah, more than anything else, I would just say thank you so much, and sorry to burden you with that shameless self-promotion, but I hope that those things are actually helpful for you and not just pumping myself up. So these slides are actually out there in that speech archive, but I'll send them to Davina after this as well, in case you want to hit her up for those. And more than anything else, I would just say thanks for having me, and thanks for letting me come into your home today.
Thank you, Jordan, so much. I appreciate it. We had a couple I'm going to read. I think some of the questions got answered as we were going through, but I'm going to ask people to raise their hand with more questions. One question that didn't get answered that I'm going to see if maybe you know the answer. I don't know if you do, but do you have an idea about an average of how many of our realtor family have applied for unemployment, maybe in the state of California? Do you have any of those statistics?
We don't have it, and I doubt they're going to break out realtors in particular, but they're kind of keeping the pandemic unemployment stuff segregated from the regular unemployment insurance stuff. So I haven't seen any numbers about the pandemic unemployment numbers yet, but because this is coming out of or being subsidized essentially by the federal dollars coming in to the state, I expect that there will be some reporting out, but I imagine that it's going to be all lumped together as like just independent contractors, and we won't be able to say how many were actually realtors or not. So yeah, unfortunately, the short answer is no, but that was the long-winded, nerdy answer.
Okay, great. Another question that came up is, how would or might a second wave of COVID impact an already weak economy in the Bay Area?
Yeah, I think second wave, and that's why, and I don't take any stance on this outside of just the straight up real estate stance, but that all bets are off for a recovery if there's a second wave, right? And so even, as bad as those forecasts I showed you with sales going down 35% this quarter, et cetera, that's all predicated on continuing to open from here on out, essentially, right? And we're still talking about 20 million people lost their jobs just last month, and probably more than that now in May. businesses can recover from a couple of month temporary pause with a couple of months worth of government assistance thrown at them. Some businesses, you know, if it's a 4 to 5 to 6 month, or that we're re-sheltering in place for another, you know, 3 months down the road, or we never get to really actually open back up, that's a much different proposition from a recovery standpoint, because businesses, and this is a hard number that I didn't bring today, but only 25, I think, or 26% of businesses have enough cash on hand to make it through 2 months, right? And when, you know, that number might go up a little bit with the government assistance, but, you know, again, once you get up to 4 to 5 to 6 months, it's, you know, no amount of government assistance is going to keep everybody in business at that point. And then it means that the, you know, then we do have to start thinking not about a J-shaped recovery, but really like an L or a W, or really like a jobless one, because that's a much different animal to recover from than just a temporary interruption.
That's true. Are there any, I'm not seeing any other questions on the chat. Anybody have a question that they want to ask him directly? If you want to raise your hand, you can go down to participant and click on that and raise your hand, and we can take some live questions. We have 5 more minutes if anybody wants to ask, or we can let Jordan go. Anybody?
I don't know if I should be proud or scared that I beat you all into
right? I think you scared him a little bit.
I'm going to ask you a question. This is Bita from Coldwell Banker. So for those of us who have listers or sellers who have been postponing, do you think it's safe to kind of guide them to come on the market now, or wait until June or July?
You know, I would just kind of take a very data-driven approach to that, and take these slides, which I'll again send to Davina or put them up on our website right after this, but, you know, show them the numbers on how much new inventory is down, right? The buyers who, you know, and there's not as many buyers out there for, you know, you can keep it real with them. There's less buyers than there should be during a May, right? But at the same time, there's also a lot less new listings coming onto the market. You can show them those slides where we're not seeing a lot of discounting. We're not seeing a lot of impacts to prices. And, you know, yes, if you had to pick the ideal time to sell a home, it probably wouldn't be, you know, in the middle of a pandemic. But all of that being said, you know, when you look at the actual market conditions, they don't look too bad for the sellers out there. They're not having to cut price. You know, and again, inventory is still pretty tight. So I think that everybody's got to make that decision, but there's nothing really severe in the underlying data that suggests that sellers are going to have a really tough time of it.
So now we have another question that came up. When are foreclosures coming, or short sales?
I think that we will see some foreclosures and short sales eventually. You know, I think that the FHFA has, and just the kind of financial oversight system has learned a lot from 2008, right? Where we didn't want to take any haircuts on any of this debt or do forbearance and let people figure out workouts last time around, because we, you know, we were like, that's not our problem kind of as a financial system, right? But we realized from that we can either pay now or pay a lot more later. And we didn't give people breaks, and we didn't work on trying to keep people in homes. And it resulted in the 2008 financial crisis, where many important financial institutions didn't make it, right? And so we're seeing the 5-year kind of workouts all the way up to even just tacking on these forbearance numbers onto the end of the loan in really extreme circumstances. And so I was really worried about this when the forbearances first started to happen, right? That if you lost your job and couldn't make 6 mortgage payments in a row, it was unlikely that on the first day of the 7th month that you were going to have 7 mortgage payments in your savings account to come forward with. But given that they're giving them 5 years to kind of work out those missed payments, I think it's a lot more realistic that we keep people in their homes. The other thing I would say is that we don't have those, you know, fundamental financial issues under the mortgage market anymore, where people have these 5/1 option arms, their mortgage payment like increased by several $1,000s overnight. And they made the calculation that because they had already sucked all the home equity out to buy their boat and go on that cruise and whatever, that it made more sense just to walk away from that home. This time around, everybody's in a fixed rate mortgage, more or less. Everybody has at least 3% plus skin in the game. Not a lot of zero down loans happening out there, and the vast majority of people actually have home equity, right? And so when all of those three things are true, you don't walk away from a home that you've got home equity and you sell it, right? And so that's not to say that there won't be defaults and foreclosures. I think there will be, especially maybe from those individual mom and pop rental unit owners whose tenants get 6 months of forgiveness or forbearance on making those rent payments and then decide just to up and leave once that period is gone, and the mom and pop investors might be left holding the bag. But I don't think we'll see the widespread foreclosures we saw back in 2008, 9, and 10.
Okay. All right. So I've got, I think, 3 more questions and then we'll be done. So let's see. When is a good time to sell the property if the owner needs to sell?
Best time to sell? I don't know. It's not that bad of a time to sell. You want to sell when the inventory is tightest, and inventory is still pretty tight. And again, I think if you have to sell and your job changed or what have you, and you have to move across the state or the country, or life circumstance changed, there's not a lot of discounting, and we haven't seen much impacts on the price side. And I think that's what sellers ultimately care about, right? Is that am I going to get what I ask if I price it properly, or am I going to have to really slash those prices? And so from that standpoint, I think that it's not a terrible time to sell.
Okay. The next one, given the unemployment and work at home habits, when will we see income property prices drop?
Interesting. Yeah, I think that the price impacts in general, we're expecting sometime in the third quarter. I think that sellers are still in a mode where they see this as temporary, but eventually these 20 to 35 million job losses / unemployment numbers will, cause sellers to have to, they're going to see days on market once those get unfrozen after the shelter in place. Days on market will be going up a bit. There's not as much buyer traffic out there, so there will be some reckoning for sellers, but I think it's again just in that kind of single digit kind of range. And I think we'll see that happen again just in the same way that we saw kind of the high end of the market impacted very early on because of the stock market stuff, and the lower end, it took a while for those jobs effects to start to show up. I think that that's kind of what we're looking at in the price data as well, that we'll see eventually the kind of broader macro impacts filter through to prices, even though we haven't seen it yet. So yeah, I think something in the third quarter is when we should see those prices soften, but again, only in those kind of mid to low single digits.
Okay. All right. So last one for you. This Stephanie Pasquale, more of a comment to an open-ended question, but every lender I've talked to has talked about cash shortages, preparing for millions to go into forbearance, the lack of bridge loans, etc. Is this alleged 2021 recovery for real, or are these lender indicators something to muse on?
Yeah, I think that lending is a big concern right now, especially in the Bay Area where there's lots of jumbo and non-QM money that people have to use, and we can't just all go out and get a Fannie and Freddie conforming loan for sure. That being said, I think that it's all just a function of the uncertainty, right? That they, as the jobs, numbers start to ease and we're not adding millions and millions of people to the unemployment roll every week, that bankers want to make money. They just don't want to be the ones left holding the bag. They don't want to originate a loan that the very first month the borrower goes into forbearance and they're still there forwarding on mortgage payments to the investors. And so I think that it's just a question of getting those liquidity numbers back and getting past some of this initial uncertainty. I think that the financial markets are the ones that respond quickest to market opportunities. And so I think that once they're confident that they'll be making money again, they're going to jump back in too. And I think that's all just a function of, again, getting the virus behind us, getting the economy to gradually open back up. And so I think that challenge for sure, but I think one of the things I'm optimistic about getting sorted out sooner than later eventually.
Well, Jordan, I can't thank you enough for being with us on our town hall. We will bring you back again because I know this is an ever-changing atmosphere for us, but we will bring you back on probably next month. Thank you, everybody, for joining us for our town hall meetings. We welcome more speakers in the coming weeks. Thank you again. So take care and be safe.
Thank you, Jordan.
Thank you.
Thank you all. See you on the next one.
Take care. And this will be recorded and slides will be made available. Take care.